Hi there, welcome back, and my congratulations for making it to the last episode on this course on the theory of commodity spread trading. As with the other sessions, and not to break with tradition, this one will be divided into two videos. We're going to take a theoretical look at the actual way you should work in the commodity spread market, the operational ways of working to allow you to get the most from it. In this video, we will look at the experience that you should try and gain before you start to successfully trade, the operational factors you need to consider, and some tricks of the trade to increase your chances of success. So, let's look at what experience you need to gain to really succeed as a commodity spread trader, and what factors you will need to take into consideration to achieve this. To kick this off, I'd like to use one of my favourite quotes from Oscar Wilde. Experience is the hardest type of teacher. First you take the exam, then you have the lesson. I have no problem in telling you this is what it was like for me. I started with only a little experience, trading got under my skin and my money walked out the door. Building your knowledge of the markets really is key to becoming a successful trader. You either have to be very lucky or exceedingly gifted to make steady profits when you first start, unless you've managed to gain enough experience to trade effectively. This course has been built taking experiences and knowledge gained from the past, and I really want to transfer this to you to speed up the process, but also to protect you, hopefully providing the right advice to prevent any of my own negative experiences happening to you. So now I'll show you the steps that you need to follow, the same ones that I recommend to anyone looking to start trading, and in particular commodity spread trading. There are 5 steps I recommend that cover the experience you have and therefore the types of trading you should undertake. For those with little experience in trading, it's good to go through a trial period before you can actually undertake your first real trade. Start with some demo trades, that way you can go through the process of identifying the opportunities, undertake the right analysis, confirm which you want to do, and then watch them unfold, as they would with real money, but without the risk of losing your hard-earned startup capital. It may sound like overkill, but I would strongly recommend around 20 to 25 trial trades to really understand the mechanics and movements before moving on to real cash deals. Think back to when you were a child. Did you jump on your first bike and ride off into the distance without the slightest wobble? Or did you employ the use of stabilisers for a period of time to help build your confidence? If you go for the no stabiliser approach with trading, you aren't risking scraped knees or skinned elbows if you fall off at this stage, but you risk putting a dent in your account balance. Take the safe route, build your confidence, and soon the stabilisers can come off. You may suffer a little loss of pride if you fall off a few times whilst practicing, but that also means that you can learn to keep your emotion in check with regards to it. If you aren't exactly new to trading but are new to spread trading, again I would recommend a number of practice demo trades to hone your strategy before starting with your real hard-earned investment capital. So when you're ready to approach the real market, it's advisable to start simply, using only intramarket spreads that don't exceed say $500 to $600 margin. This way you're not throwing your capital into overly volatile and speculative trades. Limit your real trades to start with. You can then start to build out your portfolio whilst at the same time continue with the demo platform to practice spreads on the more technical or volatile commodities. I cannot stress it strongly enough that experience builds success. Only after learning how to properly manage the simple trades should you move on to the more demanding ones. Once you've built your experience, you'll be able to expand into the more complex world of intermarket spreads. Soon you'll be able to achieve a return of around 4 to 5% monthly, but don't let the learning stop there. Practice always makes perfect, as the saying goes, especially if you want to make it your goal or your reason for trading. If you're not sure about a possible trade, if the analysis doesn't back up your gut feeling, then don't do it. Or at least don't do it with your capital. Test it out on a demo platform. Okay, it may have been a winner. You'll have that knowledge for the next trade. But what would have been the position if it was a dud and you'd invested in it? Well, you wouldn't have the same amount of capital to play with for a start, would you? Now, after understanding the experience necessary to start in this business, I'll show you some other useful operational factors. Pay attention to the relationship between trades. It's preferable that a trade you want to open is not related to another that you may already opened in your portfolio. For example, if we're already exposed to a certain raw material, let's say cotton, it would be better to diversify by opening a position using another commodity such as corn or soya. Simple message here is not to put all of your eggs in one basket. Look at the amount of capital you are risking per trade and also consider connected trades within your portfolio. For example, assume trade S1 shown on the screen was already part of your portfolio where you have bought a gold-silver spread. By undertaking trade S2, where again you are buying a gold-silver spread, albeit using different futures dates, you may be allocating more capital to those commodities than your plan and strategy allows for. It may be better to look to trade with other metals or a trade using another commodity group altogether. Why are you asking? Well, it's the capital risk that operating with the same commodities can create within your portfolio. In this scenario, to calculate the total risk of capital, you would need to add the value of the stop loss for the first trade to that of the second. If this goes over your 5% limit, it would be advisable not to make the second trade. So we know it's important to diversify. We look to find opportunities and build a portfolio of diversified trades in different groups of commodities, such as meat, energy, metals or tropicals, coupled with different lengths and expiries. This strategy will make the portfolio on average more efficient and easier to manage and maintain. In addition to the above rules, the following aspect must be considered with equal attention. Conflict between various spread trades should be avoided to prevent confusion in your position, and also because they're usually not very productive. But if by chance you do trade spreads that conflict with one another, you must continue to consider them as separate unrelated trades. So let me try and explain this as clearly as I can. In case 1, we trade XY, where we go long of X and short of Y, as well as trading YZ, long of Y and short of Z. The platform will show only one position from the two combined traded operations, and that will be XZ. The reason? In the two transactions, we've gone long of Y on one side of the trade and short of it in the other trade. The system will effectively see these two actions cancelling themselves out, therefore leaving the trade of going long X in the first trade and short of Z in the second one. The two Y trades are eliminated because the future was first sold and then bought. If one of the two trades is subsequently closed, the other will automatically return to what it was. Therefore, even though the system may not show them, you must consider them as if they were two separate operations. In case 2, we trade XY, going long of X and short of Y, as well as trading ZY, long of Z and short of Y. In this instance, the platform will consider the combination of the trade to be X minus 2Y plus Z. This creates a complex spread in the system. You must continue to monitor it as two separate operations, since, as in the previous example, the closure of one of the two trades will automatically cause the other one to be reinstated. Another consideration is the risk level associated going short the two Y futures. As mentioned in the course, our risk should not be over 5% of our capital. It's part of our strategy, which again we have mentioned a number of times and should be adhered to at all times. Therefore, if you plan to undertake the two spreads, you need to calculate what the value of the risk will be going short two Y futures. If it's over 5%, one or both of the trades should not be entered into. Okay, so this brings us to the end of this video. We've looked at how to build your experience and the benefit that this brings in becoming a successful and consistent trader. We've also looked more at the risks and correlation and the importance of ensuring that you diversify your trades across a number of commodities rather than try and focus on only one or two. If you're trading on the same commodities and using the same futures in different spread trades, remember the impact that this could have on your levels of risk and ensure that you're still within the levels set out in your trading plan and strategy. So next time we meet, it will be the last time in this theoretical course on commodity spread trading. In the next and final video, we will look at how to increase your experience and cover some more operational factors that you need to understand. I'll speak to you soon. Bye for now.